Dear students, I welcome you to my video lectures. Today I will cover common size and index analysis, which is the last topic of chapter number 6. Please pause this video, get your pen and paper ready and take quality notes because this is a very important topic. I'll give you a quick recap. So as I told you in my last lecture that as a finance manager you will need some analytical tools for making informed decisions. Ratio analysis is actually one of the most powerful tools that you will need as a finance manager. In the ratio analysis, we covered liquidity ratios, then we covered financial leverage ratios, coverage ratios, activity ratios, and profitability ratios. And as I told you in one of my lectures, that these ratios can be actually divided into balance sheet ratios, income statement ratios, and then mix ratios. Balance sheet ratios are those ratios in which both the accounting numbers are coming from balance sheet. Income statement ratios, on the other hand, are those ratios in which both the accounting numbers are coming from income statement. Mixed ratios, one of the accounting number is coming from balance sheet and the other one is coming from income statement. Something that you should be very careful while doing ratio analysis. Whenever you are calculating mixed ratios, the balance sheet item has to be averaged out. So for example, if you are calculating a mixed ratio for 2003, the balance sheet item you have to take an average of 2003 and 2002. Then we also covered trend analysis. So trend analysis is actually an analysis of all those ratios over a period of time. If you are comparing, let's say, a ratio for a company, for example, OGDCL, for year 2016, 2017, 18, 19, and if you are comparing, for example, current ratio, it's a trend analysis, it's a typical trend analysis. But internal trend analysis does not give you enough insight. You have to compare it with the industry. So another level of trend analysis is that you plot your ratios against industry and you try to find out whether your company is doing well compared to the industry, or let's say whether your company is underperforming. Another powerful approach that we used in ratio analysis is actually DuPont approach. We use that approach for calculating return on assets or return on investments. And then we also use the same approach for calculating return on equity. So return on asset and return on equity, of course, it gives you a number, but in order to dig further, where are the problem areas, let's say if you're not happy with the ratio, it bifurcates. So for example, return on asset, you can bifurcate that ratio in terms of sales profitability and asset efficiency. And then you can see whether your sales profitability is poor or you are not, let's say, utilizing your assets efficiently. Return on equity, we can also divide that into three components. The first one is net profit margin, the second one is asset turnover, and the third one is equity multiplier. So DuPont approach, although it was developed in the 1911, I believe, it is still a very powerful approach because it gives you further insights. In today's lecture, as I said, we will cover index analysis and common size analysis. So common size. This analysis converts all your financial statement items into percentage. And how do we get that percentage? We actually divide all balance sheet items by total assets. So in other words, we express all balance sheet items as a percentage of total assets. That is called common size analysis. And I'll tell you in the coming few slides that why do we need it? Why do we need common size analysis? I'll give you some applications for that. So if we are doing a common size analysis for a balance sheet, we divide each item of the balance sheet by total assets and express it as a percentage. That is common size analysis for balance sheet. For income statement, on the other hand, we divide all items of the income statement by net sales or revenues. Something really important, so please keep in mind that let's say if you are reading a balance sheet of one company and compare it, let's say I would like to compare it with another company, sometimes their titles of accounts are a little bit different. For example, some may use inventory, the word inventory, and someone may use, let's say, stock and trade. So do not get confused with that. It doesn't make a difference at all. So common size analysis, I repeat, for income statement is when you divide all income statement items by net sales. So in balance sheet, we divide everything by total assets. In income statement, we divide everything by net sales. So this is basket wonders, if you remember. It's a very simple balance sheet, but at the end of the day, even if it's complex, it doesn't make a huge difference. At the end of the day, it's the same thing, same process. So on the left hand side here, we have balance sheet numbers for year 2001, 2002, 2003. For common size analysis, as I told you, we have to divide all numbers by total assets. Why do we do that? There is a simple reason. If you see here for 2001, the total assets of basket wonders is 1,223. In 2002, it's $2,044. For 2003, it's $2,169. So we cannot, because the asset size is different for all these 3 years, we cannot simply compare the absolute numbers. And if you remember from my first lecture, comparing absolute numbers is misleading. It doesn't give you any information. So what we are doing right now, we are actually bringing them to a common size. That's why it's called common size. So everything is converted into 100. And how do we do that? We divide, let's say, cash 148 by this total assets, and we get this number. This is a percentage number, by the way, as you can see here. And total assets, of course, if I divide 1,223 by the same number, I get 100%. So if you add everything here, it should add up to 100%. We exactly do the same thing for 2002 and do exactly the same thing for 2003. Now, how do we interpret that? So suppose if you look at cash, cash was 12% of the total assets in 2001, but if you see, cash has went down significantly in 2002. It may or may not be a good sign. It may be a good sign because cash is, as you see, it's a non-productive asset. So sitting on a heap of cash, it doesn't give you any profitability. So the best thing would be to actually invest it and get some return on it. On the other hand, if you are keeping too less of a cash, it's not good for the liquidity of your company. So you have to, as a finance manager, you have to make those decisions and find a good balance. So this is common size analysis. I will repeat what you do. You divide all numbers, for example, 148 divided by 1,223. 283 divided by 1,223. Do not worry about the calculations because at the end of this lecture, we will also do some Excel exercises. Now, the common size analysis for the liability side, it's exactly the same thing. Total assets plus liabilities, it's actually your total assets, so exactly the same thing. You divide all those individual numbers by 1223. And why do we do that? As I said a few moments ago, in order to compare the numbers for 2001, 2003, and 2002 and 2003, comparison of absolute numbers does not give you enough information. You cannot simply compare it, and the reason is because the balance sheet size in 2001 is very different from balance sheet size in 2002 and 2003. So in order for a good comparison, first of all, you have to bring them to a common size. That's why it's called common size analysis. Now, income statement, again, very simple. You divide all individual numbers by your net sales, by these numbers. And why do we do that? Since I told you earlier that in order to compare, we have to bring it to a common size. So we convert all those net sales to 100%, and then we divide all those individual numbers by net sales. And these are percentage numbers. All these numbers should add up to 100%. Now, how do we interpret those numbers? So if you see here for 2001, cost of goods sold was 68.3%, and your gross profit here, this percentage means your gross profit margin was 31%. In 2002, it reduced to 28%, and in 2003, it further reduced to 27%. So with the first glance, I can tell you that actually the company is not going in the right direction, because the cost of goods sold is keep on increasing and the gross profit margin is declining. On the other hand, if you see admin, which is like the administrative expenses, if you see the administrative expenses are gradually increasing. In 2001, it was 14.6% of total net sales. In 2002, now it's 18.2%. So it jumped by close to 3.6 percentage points. For 2003, it's the same thing. So compared to 2001, 2002 and 2003, the administrative expenses are a little bit higher. So common size analysis actually gives you a very, very good understanding of those numbers, and then you can simply cross compare them across different years and make some conclusions. Now, index analysis. Index analysis, again, you convert all financial statements into percentages. But now what we do, we actually choose a base year and make it equal to 100, and then we convert all individual items according to that base year, and I'll show you in the next few slides how do we do that. So how do we do that? All balance sheet or income statement figures for a base year equals to 100%, and then subsequent years financial statement items are expressed as a percentage of that value in the base year, and the way it looks is exactly this. So for basket funders, it's exactly the same balance sheet. What we do now, we pick a base year. So in this situation, this is our base year. So base. Sorry for my poor handwriting. So cash, if you see, we converted that cash into 100, and then we converted the subsequent numbers. We in fact express the subsequent numbers, the subsequent years as a percentage of the base year. So if the base is 100, how do we get this number? We divide 100 divided by 148. For 2003, what do? We divide 90 by 148. So the way we interpret it, cash in 2001, if it was 100, in 2002 it is 68.7%, which means that there is a decline of almost 22.4% over year 2001. And if I compare 2003, the level of cash was decreased by 39.2%. All the interpretations are actually made relative to the base year. So let's say if the cash in 2003 decreased by 39.2%, it's actually decreased compared to 2001. So all the interpretation are relative to the base year. Liability side, we do exactly the same thing. 2001 is our base year, and we divide all the subsequent years by the base year, and then we get those percentage points. Income statement, again, we pick our base year, which is 2001, and then we divide all the subsequent years by 2001 and get our numbers. So how do we interpret, for example, net sales? So if net sales in 2001, let's say if they were 100%, in 2002 it increased by 70.5%, and now the new level is 170. In 2003 it increased by 79%, and how do I get this 79%? It's pretty simple. 179 minus 100. It gives you a percentage increase in this situation, but it may actually show you a decrease as well. For example, here in earning before taxes, if you see, earning before taxes reduced. And why did it reduce? Mainly because of increase in administrative expenses. And of course here, if you see, the interest expense also shot up. From 100 it increased to 255. So index analysis and common size analysis, it gives you actually a macro picture, and then you can draw your conclusions by looking at these numbers, and then you can make decisions accordingly. Let's move to some Excel exercises. So as you can see, this example, I'm actually borrowing it from the book. It's for Aldine Manufacturing, and these balance sheets are for 2000, 2001, and 2002. So how do we do? Let's start with common size analysis. So the way I do it, let's copy these headings. So copy, and I'll paste it here. And how do we get these numbers? So we divide all individual items by total assets. Okay, so in the first step I will make a mistake, a common mistake that normally students make. So let me make a mistake first, and then we will rectify it. So if I enter here, of course I get a ratio. What I can do in Excel, actually I can drag it down, and if you see here, because of the mistake, what it does, it copies actually the relative cells. So if you see, the account receivable is divided by an empty cell here. So how do I rectify it? Let me do it again for you. So whenever we start a formula, we always start with equal sign. So individual item, which is cash, divided by total assets. And now you have to lock this cell, because I need all numbers to be divided by total assets. So this cell needs to be locked, so it doesn't move. So how do I do that? The way I do it, press F4 and it locks the cell. Enter. And what I can do, I can actually copy it. Okay, And if you see here, here are no numbers, so I'll actually delete it. Now I can do exactly the same thing. This one divided by this one, and then I lock the cell. And there is another efficient way, and I'll show you shortly how do I do that. So I copy everything, and then I remove this one. Okay, since we do not have any number here, so that's why it's give me an error, so I'll remove this one too. Divided by this one and lock the cell. Okay, I remove this one. Okay, so this is our common size analysis of the asset side of the balance sheet. Now, as I told you, there is another very efficient way of doing it. So how do I do that? Let me erase it first. So this number divided by this number, and if I lock it, so the first dollar sign tells you that actually D, which is column number, so D is locked, and then 19, which is the row number, it is also locked. So if in this situation, if I lock only the row number and then I keep the column as floating, then it solves my problem. Let's see. Copy it like this, and then what I can do, I can actually copy like this. This one I can delete, these one I can delete. Now, in order for you to make sure that whether you are doing calculations right or no, double click on any number, and you can see it divided actually 178 by by the total assets. And the reason I unlocked the column, because when I drag it to the right side, so if I copy it like this, and then let's say like this, and then I drag it to the right side, of course I need to unlock the column. So I lock actually the row, but I keep the column as floating, so it can float, and then I can copy the formula. Now the next step, select all those numbers, and then you can convert it into percentage here, straight. Now it didn't show me like the decimal points. You can actually increase the decimal points from here. So let's say if you would like to, normally we go to 2 decimal points, or you can keep it to 1 decimal point. That's up to you. So everything is nice and simple now. So the way I interpret those numbers, for Aldine in 2000, cash was 6.36% of total assets, and it gradually decreased. The drastic changes that I can see is, for example, this account receivable. Account receivable was only 2.13% in 2000, and for 2001 and 2002 they are in the range of 20 plus percent. We can do exactly the same thing to our liability side. So what we do, I divide individual item by total assets. In this situation, it's total liabilities plus shareholders equity. It's exactly the same thing. And as I said, lock the cell, but keep the column floating. So remove the dollar sign ahead of D. Enter. Okay, so don't worry about the dollar sign. Okay, and then what I can do, I can actually copy it to the right side. So it copies all the relative cells. And as I said, the first test you should do is double click anywhere just to make sure that you are doing everything correctly. So if you can see, this number is obtained by dividing 191 by total assets, which is correct. Okay, and as I said, if you are expressing in 2 decimal points, please be consistent. So let's say if you're expressing this one, let's say in 1 decimal point, that's not a good practice. So if you're expressing your asset side in 2 decimal points, stick to the same formula here, so 2 decimal points. And this one, since it was an empty cell, so I'll remove these, and then I'll remove these two. It doesn't add any information here. Okay, so this was the common size analysis of the balance sheet. Let me move to common size analysis of income statement. So first thing first, I'll copy the headings. And now this can be obtained by dividing all individual items by net sales. And as I said, you have to lock your first, sorry, the denominator, and remove the dollar sign before the column number. And then I can copy it like this and drag it like this. The next step is convert it into percentage points and keep it to 2 decimal points. Easy peasy, nothing complicated here. As I said, as a business graduate, I would love you to learn actually Excel. It's a very, very powerful tool. Of course, if you're on this, if you're working, let's say for a company, they may have more superior tools. It makes your life easy. But let's say if you're working in a company in which they use mainly Excel, please get expertise on Microsoft Excel. It's a very, very good tool. So the way we interpret now these numbers, for example, cost of goods sold, if you see, it gradually increased and then decreased in 2002. The thing which catches my eye is the gross profit margin. In 2000, it was 35.8%, and in 2001, it actually reduced to 32.81%, and in year 2002, it is also 32.87%. Administrative expenses, let's see, selling, general, and admin expenses. If you see, they're pretty consistent actually for Aldine. In our other example basket funders, the admin expenses actually shot up in 2002 and 2003. Earnings before interest and taxes, if you see, there is a consistent decline. So for year 2000, it was 15.73%. It actually reduced to 10.2%, which is a very significant reduction in earnings. If you see here, earning before taxes, of course, if the earning before interest and taxes is reduced, it shows in your earning before taxes as well. So this is a very easy way of doing common size analysis of balance sheet. Now let's move to index analysis. Now index analysis, again, easy peasy. So the first thing first, copy the titles. And now how do we get that? We pick a base year. So in this situation, it's year 2000. So let's say if you're dealing with a 6 years data, I have seen analysis normally from 3 years to 6 years in practice. There is no right or wrong. As a finance manager, it's your discretion. Let's say if you would like to deal with, let's say, 5 years data, fine. But if you think that, let's say, the past 2 or 3 years are more relevant to your business, maybe you can do a 3 years analysis. So how do we do index analysis? we pick a base year. In this situation, it is, let's say, year 2000, and we divide all numbers by the base year. So again, let me make a mistake first, and then I'll try to rectify it. So if I copy the formula to the right, okay, so, and let's say I double click here, it actually divided 178 by 178. This is not what I want. I want 178 divided by 164. So the way I rectify it, now I have to actually keep this d floating, and then I have to lock what's this called, the row. So I can put actually a dollar sign by either pressing F4, or maybe you can put straight by typing the dollar sign. Okay, again, it's a mistake, and I'm happy that I'm making mistakes so that we learn together. So instead of locking actually the row number, here I have to lock column. Sorry, yes. So let me lock the column, and if you see here, if I copy it now, of course it gives me a different number. And now let's verify it. Double click on 2000. So what it did, it divided actually 2000 by 2002 by the base year, which is 2000, which is correct. And what I can do now, I can actually drag it down. And as I said, whenever you drag your formula, always double check. So let me do a check here. So yes, it did it correctly. So it divided actually the item from 2001 and divided it by a base year, which is correct. What I can do, I can exactly copy this formula here, copy, and sorry, what I can do, right? And then we can get rid of this one because there are no numbers appearing here. So I'll get rid of this one, I'll delete them. This one, if you see here, there is a no value here, so that's why it gives me an error. So I'll remove this one too. Okay, since I copied my formula again, let's do a check. Double click anywhere, and it gives me the calculation correctly. So it divides for, let's say, for other assets, it divides the year 2002 by the base year, which is correct. Okay, the next step, convert all these numbers into percentages. So press percent sign, and then in order to be consistent, let's make them up to 2 decimal points. Now if you see here, one of the things which really catches my eye is the account receivable. So account receivable in 2001 and 2002 jumped very sharply. I actually made this data up. This data is actually coming straight from the book. I made this up, and the reason I kept this small is just to give you an idea. Let's say if something is abnormal, you have to look back and see whether the numbers you entered in the spreadsheet correctly. So let's say if it's correct, as a finance manager, it should catch your eye that, oh, okay, my accounts receivable are jumping very sharply for 2001 and 2002. And similarly, you can interpret all other numbers accordingly. We can do exactly the same thing. So let's say if I copy the formula here, so let's say if I press Control C, it copies the formula here, and if I Control V here and then double click on it, sorry, let me do it again. Okay, and then drag it to the right, and let's see if I would like to confirm the formula. Yes, the formula is correct. As you can see, it divides 2002 by the base year. And then what I can do, I can highlight the whole row and then I can drag it down. Okay, and then I can get rid of those numbers. So since there are no numbers here, that's why it gives me an error, and I'll get rid of this one too. And as you can see, it's nice and easy. The first thing, you have to enter the formula correctly. And in common size, you have to lock either, let's say, the column or the row. And in index analysis, you have to do exactly the same thing. Whenever you copy a formula, as I said, double click anywhere and see whether the process in which you copied the formula is actually doing everything correctly. Example, double click here and you can see that everything is correct, so you should be rest assured. Okay, so if I do exactly the same thing for the income statement, so copy the headings, and then what you do, you start here and divide everything by the base year. So by the base year, and then I lock actually the column by putting a dollar sign. So I have to move my cursor to the right. Okay, and in order to, by the way, copy your formula, in the cell there is a small dot on the right lower corner, and whenever you put your cursor, it turns into a black plus sign. Then you press, then you click and drag it to the right. The other thing you could do is either you drag it down like this, or there is another way. So how do you do that? Whenever your cursor converts into black plus sign, double click. Sorry, it doesn't, and I'll tell you why it's not doing it. Let me tell you why is it not doing it. So Control Z. Okay. 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 So whenever there is a column empty here, it doesn't do whatever I would like it to do. So let's say if there is no column, empty column between my data and my analysis, what I can do, I can go to the bottom right corner, and when your cursor turns into solid plus sign, double click here, and then everything automatically copies, and it copies actually relative cells. Again, whenever you do a copy process, always double check. So this number is actually obtained by dividing 2002's number by the base year, which is correct. Great. The next step, convert all those numbers into percentages and then 2 decimal points. The other thing I can tell you, which is really important, let's say if you're managing your files, is you have to name your sheets accordingly. For example, the name of my sheet is income statement and index. So it tells me right away that this sheet contains index analysis of income statement. This one, if you can see, it's a balance sheet index. And this one was income statement common size and of course balance sheet common size. Okay, although there's another type of analysis, although this is not in the book, but it's a very, very important tools as well. Suppose as a finance manager, you are interested in, let's say, percentage changes. And the way we do it, the way we do it is, number one, uh, copy the titles. In fact, you do not have to copy the titles. So percentage changes are normally done through, let's say, if I'm interested in percentage changes, let's say, of cash in 2001 compared to year 2000. So the way I do it is, you always start with equal sign. Of course, first of all, you have to calculate change. So again, I will make a mistake first and then we will correct it. So this is the change, and you divide it by the base year. And the reason it's called base year, because it always shows in the denominator. So if I do that, it's a mistake actually. Now how do I correct it? Of course, I have to put parentheses. Otherwise, it's dividing D6 by D6, which is not correct. Oh, sorry, I made a mistake. Apologize. So you start with sign, within parentheses 175 minus 164, and then you divide by the base year, which is 2000. Okay, never mind. Since it was a very small number, and that's why it was showing me 0, otherwise it's not 0. So 6.7%. For the next year, what we do, so within the parentheses 178 minus 175 and divided by 2001. So in this kind of analysis, the base year actually keeps on changing. And the reason it keeps on changing, because as a finance manager, let's say if you're trying to compare, let's say, accounts receivable for 2019, maybe data comparing it with 2015 will not be a good idea. So what you do, if you are interested, let's say, in annual growth. So for example, how did the cash responded in each year? In one year it may have increased, in another year it may have decreased. So you are interested actually in percentage changes from one year to another year. So the base year itself, it actually keeps on changing. So if you see here, for the first year, my base year was 2000, and for the second one was, base year was 2001. So this one is, let's say, percentage change for 2001, and this one is percentage change for 2002. And then what I can do, of course, I can copy these numbers, and let's get them to 2 decimal points, and I will get rid of these empty cells. Okay, so this is my heading actually, so let's not worry about that, and let me turn them to bold. So this is for percentage 2001, and this one is percentage 2002. And let's say if you do not see the full text, what you can do, go here and double click, and it will adjust actually the cell size accordingly. So how do we interpret this? If you see here, my cash actually increased. It's a number with plus sign. So my cash increased by 6.7% in 2001, and it increased by 1.7% in 2002. But 6.71 percentage points compared to what? Actually increased compared to year 2000. This 1.7% increase is increase in year 2000, but compared to 2001. So it's a year-on-year increase. It's a year-on-year changes. The other thing you could do is actually select your data, and then you can do, let's say, conditional formatting. For example, as a finance manager, you may be interested, let's say, in knowing the negative growth. That is something which may worry you. So you go to conditional formatting here, highlight cells, and then less than, and then you give it a criteria. So suppose anything less than 0, you highlight it for me. So as a finance manager, it catches my eye that, oh, okay, my account receivable actually decreased in year 2002. For example, my next fixed assets decreased by minus 1.0%. It's not a big change, but this is something that you may be interested in. So you can do lots of things actually in Excel, and I will encourage you to practice with Excel. It's a very, very helpful tool. We can do exactly the same analysis for income statement. So we can do percentage. So let's say PC percentage changes for 2001 and percentage changes for 2002. And how do I get these numbers? Of course, equal sign. First of all, you find the change. So how do we get that? Year 2001 minus year 2000 divided by year 2000. And then we copy the formula to the right. And if I double click here, it's exactly the same thing. So I did not need to lock my cells. And the reason, because here the base year is moving. For the first calculation, it was 2000, the base year was 2000, and for 2002 the base year is 2001. So what I can do, I can copy all those numbers to the down, and then what I can do, I can double check. So yes, everything is correct. Next step, convert all those numbers into percentage points, and then of course decimal points. So we are keeping all calculations to 2 decimal points. This is what we have been doing in the last few minutes. So you have to be consistent, as I said. And for normally negative changes, as I told you, maybe in common size index analysis, but most importantly in percentage changes, what you can do conditional formatting. Go to highlight cells and go to less than criteria, and then you put here. So format cells that are less than 0, which means negative. Okay, and you can see all negative growths, changes, you may call them changes or percentage changes in red. So yeah, it catches your attention right away if you do conditional formatting. So I will highly encourage you that you do some Excel exercises, sharpen your skills. As I said, it's a very, very important tool. I'm done with my lecture for today, and the way you will learn from it, please watch this video. I've already uploaded the PowerPoint slides the other day. Read chapter number 6, of course, and do some exercises. Any questions, you have my email, which is mazulla@gk.edu.pk, or send me your question through WhatsApp. For ratios, as I told you in my last lecture, page 156 and 157 of the recommended book, it provides you an excellent summary of all financial ratios. Feedback, super important. So I have already shared with you this link, and I'll share with you once more. Once you watch my video, please leave me a comment. It really helps us. It helps the management to fine-tune our lecture delivery so that it meets your needs, and so that it's the best way for you to learn from it. I thank you very much for your attention. I hope you learned something from it. As I said, the most important thing is download any data from Google, play with it. The most important part is Of course, you can calculate any ratio as I told you in my last lecture, but all those ratios should make some sense. And as long as it has a logical interpretation and you can use that for your decision making, you can come up with any ratio. We hardly covered maybe a dozen ratios in our book, but in practice there are many more. The one that we covered are the most important ones, but of course you should not limit yourself. You can be creative, you can come up with any ratio, but it should make some sense. Any questions, as I said, please email me or send me your question through WhatsApp. I thank you very much for your attention, and I'll see you in next lecture. Thank you and have a great day.